Can war bring bond yields lower? I want to take a look at where we are in terms of the U.S. yield curve, where we've moved since the start of this Israeli-Hamas conflict that's been escalating the last several days, and take a look at what might be feasible, at least what the market is pricing in for where yields can go in the U.S. as a function of escalating geopolitical risk, and also a central bank here in the U.S. that is getting a little bit more and more fearful of that soft landing, landing as soft as they had hoped as inflation continues to move lower, and they're wary of that inflation turning to deflation and potential recession. So a lot of things on the table, but let's take a look at where yields currently reside, which is near 5% almost across the board. It's with rare occurrence that we have almost every knot in the U.S. Treasury yield curve, from 1-month bills all the way out to 30-year bonds, right around 5%, essentially a rounding error from 5%. We're looking at the 10-year, which is usually the benchmark for yields, and you can see that highs since 2007, and in that range of 04 to 07, the last time yields were this high, they didn't get much higher than 5%. And so a lot of people wondering, and the central bankers here in the U.S. as well, wondering if 5% is the high, and a lot of people kind of fearful that it might surpass that 5% and see 6%, which would be the first time since the early aughts, since 1999/2000. And you can see, obviously, interest rates moved lower after that dot-com boom. But there you have the context for where we are, how much higher we could go, but also how much we can fall. We were at essentially 0% interest rates just 2 or 3 years ago amid the pandemic of 2020. And let's start with now where the Fed is pricing their future actions and how that's changed amid the war that has broken out. As now, and this wasn't the case a few weeks ago, a month ago, as we'll get to here in a second, chances of another rate hike near 0%. And you can see here the distribution for the November FOMC meeting, the next meeting from the Fed. Almost a 90% chance that they hold interest rates where they are currently. And you might say, oh, well, Frank, there's more than a 10% chance that they hike 25 basis points. Those odds were 47% a month ago. And so the chances of a rate hike are dwindling fast, and have been in the course of the last couple of days, as well as amid this Israeli-Hamas conflict that's been escalating. Treasury yields have been moving lower across the board, especially in the short term. Long-term yields are only off 6 to 13 basis points, depending on where you look over the course of the last week. But 2-year yields are off almost 20 basis points. And like I say, the overnight rate that the Fed controls, the odds of them moving that higher have been cut fourfold, from almost 50% to around 10% there. And this does make sense. And if any options traders out there who watch volatility and understand the volatility curve over time will understand this concept very well, which is short-term yields are some of the most sensitive to news events, potential fear in the market, then they're much more sensitive to than long-term rates. And it's a similar concept as volatility, whereby if something happens in the market, either there's an economic data point that was unexpected and it's way worse than expected or way better than expected and it shocks the market, or unfortunately, there's this development of war in the Middle East, something like that happens, it's going to really shock short-term volatility. Same thing can be said for yields, because for something to move long-term yields, it's got to be a really long-lasting structural change, which isn't to diminish again, how bad the news is coming from the Middle East, but for now, the market's saying with short-term yields falling and being more volatile than long-term yields, that this is likely to be a shorter-term story than it is to be a 10 or 30-year story. And remember that it took a lot to get long-term rates to start moving to the upside. Remember, it was a similar thing when inflation spiked after the pandemic. Short-term yields spiked, but long-term yields actually took their time, and we actually still have an inverted yield curve because long-term yields haven't moved as high as short-term ones. And now they've just started to move in that direction. And essentially the market's saying that this war in the Middle East is not enough to necessarily move long-term yields in the opposite direction, but it has been enough to move short-term yields. And as we'll get to in a second, those short-term yields can have a knock-on effect and eventually move longer-term yields lower. When you look out to where the market expects interest rates to be at the end of next year, and you look at that current rate, again, the red box there, not pricing in rate hikes in 2024, but pricing in rate cuts, and the bulk of expectation around 50 to 100 basis points lower than where we are currently. And those chances of lower rates are increasing now, given the war that has broken out, and central bankers talking about how they're worried now of long-term rates being too high. And of course, we haven't had a Fed meeting since the recent developments abroad. It'll be really interesting to see if at the November meeting, Fed Chair Powell does reference the risks abroad or geopolitical strife or what have you in his statement, because if he does, then you can really see this war having a downside effect on interest rates. And you'll remember at various points over the last several years, whether it was China or Russia and Ukraine, different regions throughout the world, if the central bank here in the U.S., the Fed, says that they're monitoring that situation, even if they don't say, oh, we're cutting rates because of this situation, but we're monitoring this situation, you'll see interest rate markets price in lower projections and move lower. So it'll be really interesting to see, one, how these markets continue to digest the news that's coming out, but two, especially if Fed Chair Powell and other central bankers say that they'll be influenced by these developments, then you could see especially short-term yields move lower as they already have been. But yeah, it could take a lot to shake 10-year yields that have now gotten over 4%. And it took a while for this market to get over 4%, my friends. This is a historic climb for sure. But this was a real reluctant market, especially when you think about the fact that short-term yields were really skyrocketing throughout 2022. It took so much for 10-year yields to eclipse 3% and then 3 or 4 shots at 4% before finally getting over that hump. And so, yeah, it's going to take a lot to now slow that ball rolling in the north direction and turn it around. Of course, we'll see how this war develops, already having a huge effect on short-term yields, but not so much for the long term, which of course affects mortgages, car loans, and everything else.